As a responsible person with growing concerns for your privacy and personal liberty, you want to know where we're headed and what you can do about it. We ask the experts what you need to do to take prudent and responsible action to safeguard your family's wealth and well-being, and what basic first steps will help you to be aware and prepared. ReluctantPreppers.com.
Welcome back, Reluctant Preppers. Today our returning guest is Gregory Mannarino, a former equity trader of the equity trading arm of Bear Stearns. He's founder of TradersChoice.net. He's here back with us on Reluctant Preppers to talk about recent volatility in the equities market, including the record two-day drop in the Dow and what that spells for the beginning of the end or not, that Reluctant Preppers who want to be aware and prepared need to know about. Welcome back, Greg.
It's great to be here. Thank you very much. Appreciate it.
Now, again, just over a week ago, we had the largest ever two-day drop in the Dow, and after that record plunge, the Dow surged back and has been highly volatile, whipsawing up and down since then. We've had strongly divergent opinions voiced by commentators on the markets, some saying this really is the beginning of the end. One of those voices is Jerry Robinson from followthemoney.com, who says this has all the hallmarks of the type of collapse that happened in 2008, and he believes that it will just continue to degrade, and this really will be the beginning of that major market collapse that the people have been expecting for some time. Others, such as Fabian Calvo, say that no, there's so much interventions and other things that are possible that that the market will ride this out, and will be years down the road before we finally get what he calls the global economic reset. So if you could start by just telling our Reluctant Preppers audience what your personal opinion is based on your research and your experience on whether the recent plunge in the Dow and the volatility really is the beginning of the end of the big collapse that people have been preparing for, and if so, why, and if not, why not?
Okay. Here's the situation. It always seems to take an extreme event to catch people's attention. Now, I am, and this is a fact, anyone can look this up, the only analyst in the world who called the top of this market back in May almost to the day. Here we sit nearly 2,000 points lower on the Dow, and finally people are waking up to maybe there's a problem. Here's the issue here. There is no doubt in my mind that we are in a global slowdown, which is accelerating. We're hearing more and more news out of the world's second largest economy, China, who has taken extreme steps to stop the bleeding in their stock market. They've devalued their currency 3 times over 3 consecutive days. They're getting very desperate. And it's not just China. We are seeing this in other economies all around the world, and their markets are in trouble too. And we have our mainstream financial pundits and our politicians trying to push the narrative that the United States is immune to what is affecting the rest of the world. It's laughable. When you hear this, you have to laugh, because there is no possible way in this global economy that we're immune to anything. What affects one part of the world is going to affect us here in America. Now, with regard to the stock market and the top, which we hit back in May, the volatility that we have seen, we're going to see more of this. There is no doubt about it. And it's going to be very interesting. Yesterday, we had this market take a wallop of a fall, almost 500 points. The day before that, I had told my followers on Seeking Alpha that we are about to see an imminent drop in the market. Market plunged 500 points the next day. I told everyone how to capitalize on that by posting my stock picks on my site, TradersChoice.net. And today we did get a little bit of a bounce. This is absolutely expected. I do believe this market is going to bounce a little bit, and then we're going to get another steep drop here. And we are going to continue to see this type of back and forth play out for a while. And a lot of this has to do with what the Federal Reserve may or may not do. I don't think it even matters anymore. We understand we're going to hear from the Federal Reserve in a couple of weeks here with regard to their interest rate, whether they're going to raise interest rates or not. I think if they don't raise interest rates, that's going to put pressure on the markets. I think if they do raise interest rates, that's going to put pressure on the markets as well. A lot of dynamics going on here, but I cannot see, despite how much I look at the data, a reason why the U.S. stock market will regain an upward trajectory and surpass its recent all-time high again back in May. I think we are under an enormous amount of pressure. But again, what people need to be paying attention to here is the bond market. I always say that. Forget about the stock market. This is where people are fixated on. It's the bond market. It's the debt, which has inflated the stock market. The debt can never be paid back. The debt is being held by countries and banks. And again, we're being told that this debt is an asset. It's only an asset if it can be paid back. We already understand it can never be paid back, so it's a liability. And the debt is in a bubble. We heard from none other than former Fed Chairman Alan Greenspan last week, who was calling the bond market a bubble. He said specifically the bond market was unstable. I mean, I've been talking about this for years. I think he's a little late to the program here, but I think he's trying to cover himself here. When this thing really comes to light, their heads are going to roll. There's no doubt about it. And someone has to be held responsible here. So I think when you have someone like Alan Greenspan coming out talking about the debt market in a bubble, you have Janet Yellen herself a few months ago talking about stock valuations being high. We're still trading at 17 times forward earnings. This is, historically, the market is not cheap by any measure. So we can, again, expect all of this to correct to fair market value. That's the only job of these markets, all of them. The currency market, the debt market, one and the same. The metals market, you name a market, the stock market, they only have one job, and that is to determine fair market value. We have had a mechanism been put in place by a runaway central bank that is absolutely responsible for creating distortions across the spectrum, which will correct to fair market value. It is a mathematical certainty. Not only that, they're going to overcorrect at one particular time because of panic in this market. We have panic buying on certain aspects and panic selling in other parts of this market. This is the way it's going to play out. I have no doubt about it.
And what you're describing, that kind of panic buying and selling, leads to disproportionate volatility compared to normal buying and selling action. And I wanted to get your opinion on an article that came out this past week from a commentator at J.P. Morgan by the name of Marko Kolanovic. And he says that he blames quantitative trading, which is highly leveraged trading, may have triggered this market crash. He says specifically cited three types of quantitative trading strategies and trend followers, risk parity traders, and funds that adjust their holdings when the volatility rises or falls. And he says together, those institutions employing those tactics could force up to $300 billion of selling in the U.S. market over the next several weeks. And I wonder, since you were quite familiar with different trading tactics, if you could explain in layman's terms how sort of people who have bet against volatility, then suddenly when there is a lot of volatility in the market, may be forced to unwind their positions by doing a lot of sudden buying and selling that can really cause the market to do these big swings and gyrations. First of all, do you agree with his assessment that could be a factor that can trigger, unusual market moves? And secondly, can you explain to people how that actually can happen?
Sure, absolutely. What we have here is a market that is controlled by machines in a lot of ways and trade off of algorithms. So when these triggers are in fact triggered, you can see massive swings either way. I say, you know what? I don't think it's a bad thing. There's a lot of people out here saying, you know what, high frequency trading or machine trading or whatever you want to call this is a bad thing for the market. I don't understand that at all, because there's always two sides of a trade. There's a winner and there's a loser period at the end. So, as a trader myself, I try to look past all of that and more look at the big picture and trade accordingly. But again, we are going to see more of this. There is no doubt about it. Wild swings up and wild swings down in this market for several reasons. We're on a hair trigger here. Again, no one wants to be the last person out the door. When the stocks or any asset starts to plunge, people look to dump these things. I always go over this. It's a very simple concept. Two things and two things only drive the markets. It's fear and greed. Fear is stronger. So when people see an asset plunging, they want to get out of the way, and no one wants to be the last person out the door. I believe we could end up in a scenario where there are no buyers at one point, and there are just people looking to dump. And this is why we're going to end up seeing an over a correction or a massive drop at one particular point in this market. And we could be very close. This is what I think is going to happen. This is the scenario I've laid out recently, and it's playing out exactly like I said it would. We had a big sell-off in the market the other day. I told everyone how to capitalize on it. Very simple. Now we're going to get a bounce over the next couple of days. It's always the same thing. The market always overreacts. So with this knowledge, people like myself, hey, you know what? We take advantage of it. So we get in here. I told people this morning exactly what I was doing. I bought calls on Facebook. I went short volatility. These have already paid off, and these trades aren't even only several hours old. I think this market is going to rise into the next day or two, and then we'll get another sell-off. I mean, this is just the way this is going to work for a while. But the fact of the matter, in my opinion, is we have seen the top of this market. It's going to deleverage. We are going to have a correction to fair market value, and there's no way out. There's no way out of it. Again, the market's only job is to determine fair market value. So when you have an entity who is literally taking over the largest part of the market, I'm referring to the Federal Reserve taking over the bond market or the debt market, it has a ripple effect through everything else. The Federal Reserve has deliberately created an environment of risk by suppressing interest rates, and the price that is going to have to be paid for that is going to be extreme.
Now, for people who want to follow your advice on short-term moves that they can make to profit from some of the volatility and some of the up and down action that's happening, they can find out more about your suggestions on traderschoice.net. For people who are averse to that kind of trading and they really don't want to be involved in that, what can an average person who wants to take a conservative approach in the face of this kind of risk and volatility do, in your opinion?
Well, my opinion has been the same as always. Become your own central bank and bet against the debt bubble. It is the greatest threat to humankind, bar none. This is not just a financial problem. It's a resource issue. What people need to do is understand that we are in the midst of a currency war, beyond any shadow of a doubt, and we're going to see the paper money market eventually implode on itself. So what does that mean? That means we need to get out of their system. We need to start acquiring hard assets, something I've been saying forever now. This is a long-term trade. I mean, I've been buying metals for years and years. I will continue to buy them until, again, I feel there's a time not to do that, and that is probably a way off. But that's the best way I can envision at this point as to try to protect yourself for those who are not, bobbing and weaving out of these markets here. So bet against the debt, become your own central bank, period, the end.
Well, Gregory Mannarino of traderschoice.net, we are grateful for your participation, helping us interpret the signs of what's going on in the times, because it's certainly getting more and more concerning for a lot of people, and appreciate you being in our corner, watching out for us and helping us know how to be aware and prepared. So thanks again for joining us here on Reluctant Preppers.
It's been great. Thank you.